afternoon, everybody, and welcome. Welcome to this session. And as you noticed, we've had some technical issues, but at least we have the majority of the panel here, the whole panel actually, except our moderator, Piet, who we hope will join in a while. So we do a short round of introductions. My name is Yvonne Bakkum. I'm the Managing Director of FMO Investment Management, a subsidiary of the Dutch Development Bank FMO, and totally dedicated to mainstreaming impact investing and scale it up by letting institutional investors and other private investors co-invest alongside FMO in impactful investments all over the world in emerging and frontier markets. And it's a great pleasure to be here today. Tony?
Okay, thanks. I'm Tony Burton. I'm the CEO of Make My Money Matter. It's a campaign focused on helping people have more voice and control over their money and for their money to be invested more sustainably. And we've started our campaign with a focus on pensions. And one of our asks is that all pension funds grow their portfolio of investment that has a positive impact. Our current sort of micro campaign is on net zero, and that's calling on all pension funds to align their portfolios with net zero emissions with a halving by 2030. And it's great to see one of our members of the panel heads up a pension fund which is committed to that. So I'll hand over to you, Debbie.
Thank you, Tony. And I'm Debbie Blakey. I'm CEO of a fund called Hester, a pension fund in Australia. And our members, we've got 870,000 members who work in health and community services all across Australia, and obviously doing amazing work right now with the COVID pandemic. And we have $54 billion in funds under management and are very committed to impact and investing, and absolutely thrilled to be here with you. And maybe I'll hand over to Linda.
Thank you, Debbie. Good afternoon, everyone, or evening, depending on where you are, or morning. I'm Linda Mateza. I'm the Chief Executive and Principal Officer of the Eskom Pension and Provident Fund. We're based in South Africa. Eskom Pension and Provident Fund is the second largest pension fund in the country. We have around 80,000 members, as well as around $10 billion US dollars in assets under management. We invest in diverse asset classes, and around 35% of our portfolio is invested outside South Africa. Thank you. I don't know who's next.
Oh, Laura? I was muted. I was speaking, but I wanted to compliment you, Debbie, because your commitment is totally proven by being here with us in the middle of the night.
Oh, that's what you have to do when you live in Australia, I'm afraid. We're in a very different time zone compared to Europe and the US and, of course, Africa. So should we talk about Pete's first question? Maybe we go around. Pete's question was, how do we think about impact investing, and is it compatible with fiduciary duty? Shall we do that? I think it's a great subject. I don't know if we want to go in the same order. Start with you, Yvonne.
Yes, that's fine, but I'll keep that to a very brief answer, because my answer would be yes, of course. How could it not be part of your fiduciary duty? But then again, I'm not managing a pension fund. I work at a development bank. So maybe your answer, Debbie and Linda, is most relevant here.
Well, let me jump in maybe and say from our perspective, look, we would totally agree. And I think it's interesting if you think of that role of fiduciary, and it's such an incredibly privileged opportunity to be a fiduciary, but the trust and the confidence that your beneficiaries have that you're investing with their interests at the center in everything that you do. And for us, we really believe that that has to extend to the impact of the investments you make. So we talk a lot about it not just being the returns. Obviously, returns are incredibly important, but not just the returns, not just the dollars and members' accounts, but also very much the world that they will retire into. And I think COVID gives us such a window to look at this, where the pandemic and what it's wreaked havoc across the whole world. It's really a good example of why I think considering the impact of our investment decisions is so important. Linda, I'm sure you've got good ideas about this as well.
Absolutely, and I would concur with Yvonne's opening remark that, of course, there is no conflict between being a fiduciary and being able to implement responsible investing. In fact, they go hand in hand. I think if we are truly investing sustainably and investing for the long term. In South Africa, and I think in many African countries, we have been very conscious and really have no option but to be mindful of the impact that our investments make as pension funds, because very often the local pension funds are actually the largest institutional investors in certain countries. Certainly in South Africa, that's the case. And so they've played a pivotal role in investing for development, in investing in infrastructure in areas that are underserved. And truly the COVID pandemic has illustrated the depths of the inequalities in our countries. And so I think to invest purely for financial returns would be quite short-sighted, because it's impossible to do well financially in the midst of being surrounded by poverty and inequality. And so it just makes pure sense for us that there's an aspect of financial returns, but there's also social returns that we make from our investments. Thanks. Tony, what do you think?
Yeah, no, we're all on the same page on this, I think. It's the thing that gets me is returns, obviously, fiduciary, is prudent management of other people's money. So returns are important, but I think, as Debbie said, that future of the world that you retire into has got to be part of that equation. And like you said, Linda, whether there are social issues as well as part of that, you want to retire in a world that you can live in, that's peaceful and stable, and, all people are prospering and benefiting. And I think it's that bit that there's still a challenge. So why are we talking about fiduciary duty? It's obvious impact investment is allowable, but there are lots of conservative thoughts in industry that hold us back. And some people still say, well, fiduciary duty is an issue. You have weaker pension boards who still feel constrained by it. So I think all of us and everyone listening, we need to be really challenging this, and having leadership from pension funds to invest in widening the portfolio that has impact. This is the way we need to go to really make this the norm. Here's Pete.
Welcome, Pete. You made it.
Oh,
But you're on mute.
On mute, Pete.
So we have Pete. Thank you all.
Yes.
For your
Hello.
Hello, Pete.
Beautiful people. Are you enjoying yourself without your moderator?
We're misbehaving, Pete.
All right. Okay. Where are you? Because can we pick up on something that I sent you before, or are you on a different track already?
No, we've actually just had a great chat about fiduciary duty. I think we're done with that, and it would be great to talk about, you were going to talk about courage and incentives, so we're probably ready to go into that. All
right. Okay. I'm pulling up, I'm juggling, obviously, all these different screens that I've been trying. So the introductions are behind us already. Yeah. The question I was going to ask you, all of you, or at least some of you who represent pension funds, is on the boards that seem to often lack the courage and or the incentives to diverge from market conventions. Most of them are really index huggers. We've given the choice. And the question to you then I would like to ask is how best to develop the data, the track record, the expertise, the beneficiaries, backing perhaps, to break through this follow the herd mentality. And maybe I can start with you, Debbie.
Oh, okay. Yeah, Pete, look, it's a great question. And I think you have to create, it's a culture, actually, it's a mindset. I think it does start with the board, but I think it's across the whole organization. And maybe two ways we've done it, I think quite successfully at Hester. And the first is all organizations talk about their purpose and talk about their vision and their mission. But about 5 years ago at Hester, we added what we call our Hester Promise. And it's actually our commitment to our beneficiaries, to our members. And we promise to them that we'll be gutsy advocates and we'll drive meaningful change for generations to come. And I think that clarity of a commitment and promise from us as an organization and the real clarity of saying this is who we are and this is who we will be in representing your interests has been incredible for our culture of really breaking down some of those barriers. And really about the same time launching our incubator impact program. So for us, it's been very important alongside our 54 billion investment to actually have an incubator program for impact investing that I can talk a little bit more about at some point, but I'm sure there are lots of other ideas from other people.
Linda, would you like to weigh in?
Yeah, absolutely. In our case, we've set aside a portfolio that's designed to invest for development. So with a developmental impact in mind and also with an impact on the real economy. So the challenges we face, include in parts of the country in South Africa, inequality, poverty, lack of access to infrastructure, as well as unemployment, significant levels of unemployment. And so those investments are targeted at making investments that create employment in sectors that are able to generate growth in the economy. And currently under the COVID crisis, that's quite a tall order. It was hard enough before the crisis to direct funds and to ensure that we are able to achieve those outcomes. So now I think it's become even more compounded, and we're going to have to find some quite creative ways as to how we respond as investors to remedy the situation.
But your board is supporting you in these endeavors, even though it's hardly market convention, the things that you do.
Oh, absolutely. So this is about 3% of the portfolio overall. So it's not the bulk of the portfolio
okay.
that's dedicated to impact investing. But the board is fully behind it. We have put a policy framework in place to govern how those investments would be made, which also sets out the investment objectives, the risk parameters, the kinds of investments we will not consider, and those that will achieve the desired outcomes. So I think what gives the board comfort is that there's a governance framework around it. It's not just a case of investing haphazardly in things that we think will have an impact.
Right. And Tony, I'm sure you've got opinions about this. Is indeed this a matter of trustee or board of trustees courage, or is it a technical matter?
Well, Linda and Debbie, I imagine, have got boards that have, a bit of leadership there, but much of the industry isn't in that place. So it's partly courage, but, part of the problem, I think, is the advisors that advise boards. So certainly, trustees have limited capability. There are skills, but many of them are not professionals. These issues are really more and more complex. So the advisors, I think, are also in this herd of just staying in the same line. And I think the key is engaging with beneficiaries. What world do they want? How do they want their money invested? And I think, we know from surveys in the UK, 70% of people want their money to be invested to do good and not harm. So when we know that for our members, people are saving into their pension, what does that tell the board? It gives a sense of direction for where investment should take place and help create that world.
But Tony, if I may push you a bit on that, because beneficiaries may say that, but they do not necessarily spell out to what extent they are prepared to accept, trade-offs, more risk, a slightly lower return. first-time managers, you know, that sort of thing?
You know, others will have views. I think it's very, very difficult. This engagement with members, you know, there's an issue of financial literacy. The tradition of engagement is extremely poor. You know, the kind of information members get is obtuse and incomprehensible. So we've got to simplify it. You know, where is my money invested? What's the financial return? What impact does it have? And what can I say about that and about my wishes? And have a grown-up conversation. But that doesn't really take place in most pension funds now.
Yvonne, would you agree with that? And I know you've got very strong opinions about courage or lack thereof.
Yes. Well, I see there is an issue not only at the board or trustee level, because I agree there you need courage, and courage can only come from a very strong belief and a vision that you as a pension fund can and should make the difference. But there's also an issue at the work floor, so to speak. Because what we have noticed, of course, we have been talking a lot to many pension funds. Some have invested in our funds, and we talk at various levels. We talk to the trustees and the board, but we also talk to the investment managers, who are, of course, the ones who are due diligencing our propositions. And in many cases, we have worked with very enthusiastic investment teams who, despite being personally convinced that our investment proposition was a good one and is a good one to make impact and return, they were not facilitated by the same boards that you know, express to the outside world that they have a high priority for impact and sustainability. Because the incentive systems, the asset allocation models, all sorts of technical hurdles exist that those investment staff people are not able to remove. And the ones who are able to remove it are the board members or the top leadership of the pension fund, and they don't do it. And that has puzzled me a lot. So I would like to see and advocate for more consistency across the whole governance of the pension fund.
Yeah, and Tony, you were saying that, you know, beneficiaries could be a little more specific if only we would have a, you know, a mature conversation with them as to what they're prepared to trade off, if such a trade-off is required. Is that correct?
Yeah, and I think this sort of, you know, trade-offs, the, you know, risk and return across the portfolio varies, you know, in all sorts of investments. So I think somebody saying it in that way, oh, you know, if we do this, you know, maybe there's much higher risk or whatever. Risk and return is there throughout. So, you know, expanding into investing for impact, aligning your portfolio with net zero emissions, you know, these are all, I think, you know, there's a variety of risk and return there. So I just think it's much more straightforward, really.
Keith, can I add something?
Absolutely.
I think the time frame is so critically important. And this is especially for pension funds because really, you know, it's a 20, 30-year investment. We have a very interesting case in Australia where a younger member who won't be able to access his money until 2055, so a long time away, is actually taken court action against his pension fund for allegedly not taking into account climate action to the extent that he would expect to protect his money. Yep. So I think it's the time frame. When we talk risk return, if we can get our mindset to what will the world look like in 20 and 30 years, what are the key risks in the portfolio, and are they priced in, and in terms of the return? So I think that for me, in terms of pension boards, in terms of professionals in our organizations, it's about getting that time frame right.
Yeah. And, you know, talking from PGGM's experience, you know, I think a lot of our people would subscribe to that, the need and all that. And yet the constraint is, but please do it within, you know, 1% tracking error. So what would your response to that be? Debbie? You're mute.
Yeah, look, I think, that's really why I think you've got to think more creatively. And what we are doing with this incubator program, because if you almost have to have to develop the methodology, the thinking, if you have absolutes that you expect your impact investing program to absolutely conform, you're probably going to cut out so many opportunities. So a great example in this is affordable housing, which for us was in this incubator program with our social impact investment trust. And we managed to invest smaller amounts of money, but we've actually first of all, developed the methodology, but actually identified and demonstrated that it actually stands up as an investment case. And now we're seeing affordable housing in Australia become more mainstream from an investment point of view. So Peter, I think about it's a little bit of patience as well. Be prepared to be creative with a smaller amount of money.
Yeah, I think that's going to be a nice lead into our next question. Full openness to the audience. We prepared this, obviously. The next question here is stay pure or go big. Now I hear Debbie and I think also Linda say, make sure you actually get your expertise, your track record, your data in a smaller part of your portfolio before you can roll this out to perhaps a bigger part of your portfolio. Is that indeed the better strategy? Start small, go big? Or should we try to stay pure where you may run the risk that it's going to stay small? Yvonne, would you like to say something about this? Oh, yeah.
Well, I think there's always a risk. Sorry, Yvonne.
Linda, please carry on.
There's always a risk that what's meant to be a small initial allocation just permanently remains, at those low levels. So there has to be intentionality about it, and I think it has to be written into policies. So in pension funds investment policies that, over the next 10 years, our intention is to increase this gradually to a certain level. I think going big at the same time at the beginning, I think it would frighten too many people right along the value chain, from the consultant to the board itself to the management of the pension fund. It's too radical a change at one time. But I definitely think there's a case to be made for setting a goal and then saying that over the next 10 years, this is where we want to be, and this is how we will know if we've achieved success.
So Linda, this suggests at least that you've got a kind of a theory for change from a small part of your portfolio, which is very impact oriented, to perhaps slowly push the frontiers out to other parts of the overall portfolio. Is that right? Do I understand that right?
Absolutely, yes. Starting with the small portion. And once we've perfected how to measure impact in that, well, I don't think we'll reach perfection, but once we know very well how to measure impact and report on it, then we can roll that out to a greater part of the portfolio. But currently, with the tools that we have, we're not able to tell a convincing story to our board of trustees. And so there's still a little bit of risk aversion because this is not proven. So once we've gathered the data and we're able to measure with tools and to report on impact, I think it becomes a far easier conversation. And actually, once you've got that, it's far easier to move from a 5%, say, to 10% of the portfolio.
Right. Yvonne.
Yeah, that sounds like a very viable approach and very logical. And I think, Pete, where you have to go all the way and across the portfolio is when you talk about sustainable investing. Because there, I think you are not ambitious enough if you say, I will invest responsibly or sustainably with 10% of my portfolio, as some people also still do. There you can have 100% ambition, and with impact, you can build it up. And of course, I am a bit an impatient person when it comes to this topic. I'd like to see it move faster than it does in reality. And maybe the proof we need, especially in alternative investments, it's quite a long period before you really can see how it has worked out. So maybe you should not wait for the last bit of 100% proof, and also dare to be convinced of your own strategy before seeing all the results.
You know, perhaps at PGM we made a mistake to call that part of your portfolio where you like to drive for hard impact. We refer to that as sandpit, and that raised the suspicion that we were going to throw good money after bad ideas. This is, you know, a very dumb question perhaps, but how do you refer to it internally? What is that called, Debbie? Your impact portfolio? What do you call it?
Actually, Pete, we called it our impact investing, rather than the one was investing with impact and the other one was impact investing, always said together, but actually it created confusion. And so now this is why we're talking about it as our incubator program for impact. I think incubator works for us. Yeah. And we've actually had incubators with other managers. We've had incubator programs in other areas. So that really works well for us. But I think it's a really good point, because if you think of things like climate, which is actually measurable, I think, you know, carbon, there are some people who still say you can't measure carbon accurately enough to put any kind of targets or ambitions. We don't agree with that. It's not perfect. To somebody else's point, this doesn't have to be perfect to do something and to make a difference. But I think some things across the whole portfolio, for us, a carbon target across the whole portfolio really makes sense. But if we're trying to develop social impact programs, doing that in an incubator really works for us.
Yep. Excellent. Linda, would you like to just say what that impact fund is called, or the impact strategy?
Oh, we call ours the developmental impact portfolio.
Developmental impact portfolio. And then over to Tony. You know, Tony, going from pure to big, what is the perfect theory of change as you see it?
I think we've done small and pure, and we need to go big. So for me, how? So all investment has impact. And I think pension funds need to be looking at their entirety of portfolio and aligning that for impact. Now, some of that impact will be large or small, some will be social, a considerable amount will be climate impact. So I think you need to understand the whole portfolio. We'll talk about this in a while, I think, but measurement then becomes really key. So Debbie mentioned, you know, carbon measurement, but we need to move really quickly to a standard for measuring and accounting for impact. Then you know your portfolio, and then you'll start to realign your portfolio. And the thing is that consumers are crying out for more sustainable foods, clothes, you know, their lifestyles are changing. People are bothered about how workers are treated in companies. So I think this movement is growing. And as Debbie said, you know, and for Linda, they're looking ahead 30 years. We don't even know the companies that will exist in 30 years. But, you know, they've got to be sustainable businesses. Otherwise, our planet is trashed and we'll have huge inequalities. So I sort of think you've just got to look at the portfolio. So my theory of change is that issue around measurement and making that work, and then understanding your portfolio and aligning it with your strategy and your purpose and your values.
It's something that we're trying internally, Tony. You know, we're not having an impact first portfolio, but we're trying to improve the impact measurement across the entire portfolio. Hopefully that will instill a demand for increasingly impactful things. Now, this is a long process, and I'm not sure we'll be there in time. But I think all of us would agree that, you know, you can't talk about impact without proving it. So we need to measure it and manage it. Otherwise, it's just, you know, another vacuous word that we use too often. Over to perhaps to Yvonne. Yvonne, what would you like to see different in the Dutch pension landscape? You know, we are always trying, maybe not hard enough, but we're trying to put money into your funds, and then something happens and nothing, and it stops. Or maybe nothing happens and it stops. What needs to change?
I think the sense of urgency needs to change. And Tony mentioned the aspect of time. And I think many investors, including PGGM and other Dutch players, have embraced the Sustainable Development Goals. But these goals have an end date. They should be realized by 2030. And that's less than 10 years away. And the speed at which the Dutch pension funds in particular are developing their impact investing strategies is just too slow. And I think the Dutch pension funds are suffering maybe from what you call the law of being, I only know it in Dutch, de remmende voorsprong, because you are
diminishing returns. Returns.
Because you are a front runner in sustainable investing, you are a bit happy with yourself and don't believe the step towards impact investing will be so important. But there is such a big difference of mitigating the negative impacts versus actively looking for the positive impacts and looking to optimize those positive impacts. So that I think that sense of urgency has to improve. And it's really a pity to see that the Dutch pension funds are not as progressive as some of your peers in Scandinavia, but also as, for instance, as insurance companies in Europe, because they tend to be more advanced when it comes to impact investing, whereas their horizon is not naturally as long as the horizon of a pension fund. And maybe one point, I saw a nice interview with a Swedish CEO of a pension fund that I know quite well. And they asked him to answer a few questions with one word only. And they asked him, what is the main challenge for a pension fund the coming couple of years? And he said, it's return. And then they asked him, what's the main opportunity? And he said, it's the long term. And, you know, impact investing is such a perfect combination of making return and having a long-term perspective that it's such a natural fit to all pension funds.
Yeah. If I may summarize the discussion thus far, and we try to address this first point, you know, is it a matter of courage or is it a more technical issue that keeps us from growing the impact investments? I think Linda and Debbie are saying, you know, start with a small impact first strategy, build up your expertise, your experience, your confidence, your data, etc., and then roll it out in a bigger way across your portfolio. Tony says, and this is in no way contradicting, I think, Tony says, make sure you got your impact measurements right across your portfolio, perhaps that way proving that you can have impact and more impact without actually having to trade off financial return for impact. Then you, Yvonne, add something more. You say, you know, maybe just add pressure on the boards. Maybe that's more a political thing to do. Why is it that Dutch pension funds are kind of resting on their laurels and Scandinavian pension funds are more daring at this point in time? Is a peer comparison, a peer contest the way to go, or do we have too many of those already? Yvonne, or Debbie maybe. Debbie is also probably in the thick of this stuff.
No, Peter, I was just going to say, I actually think it's parallel. I mean, your summary of, you know, you start small and you build methodology and you grow that, I think it works in some areas. But to Tony and Yvonne's point, I think there's some areas that we, in a sense, almost don't have time to do that. Right. And I think we've also got to look at our portfolio. And look, I think PGGM has done amazing work at looking at the Sustainable Development Goals and looking, first of all, of doing no harm. I think this notion of being very careful, you know, you might have this amazing program where you invested in renewables, but just be careful what other investments you have, perhaps, that are undoing that. But then really just picking some. I mean, for us, given the fund that we are, one of them that we've picked is good health and well-being. and really being thoughtful about how you can invest in your broad portfolio. So I actually just think it needs to be both. And I know people don't like ambiguity. People want a black and white answer. I think in this area, there's a fair bit of ambiguity because you actually have to be able to juggle this incubator aspect of where you're learning, but at the same time, be pretty bold with your whole portfolio.
Yeah. Linda, would you agree with that?
I would, certainly. You know, the way we think of it is in the bulk, in the larger part of the portfolio, we are monitoring and measuring ESG, and we are monitoring sustainability metrics throughout the portfolio. Impact, we haven't specifically, you know, isolated and been able to produce those kind of indicators, but it's absolutely possible to do that while at the same time having a dedicated portfolio that is designed to have high impact in the form of affordable housing, education, healthcare, infrastructure, and so on. So I don't think there's a paradox at all.
No.
It just requires different approaches.
May I just make a pitch for the Impact Management Project, which is, I believe, an initiative that is really nicely bringing all of this together in a way that works for different types of investors. And I think in their distinction of avoiding harm, accidental or incidental benefit, and targeted impact, they perhaps cover the spectrum of things that we do, and all of us do. So far, the discussion has perhaps mostly been on the targeted impact. But of course, there's a lot of useful stuff that most pension funds, or at least a fair number of pension funds, are doing in avoiding harm, and indeed in lowering their carbon intensities, and indeed in raising the bar for all investments across the portfolio. I think the discussion that we just had with Yvonne is really in the column C, you know, targeted impact investments, which we at least PGGM find perhaps the hardest. Still, we slapped a target on it, and we'll see whether we'll make it. But we need courage and indeed, you know, a fair amount of expertise underpinning that. Final words, Tony. Just a quick round. What would you like to say for the people that are 3 minutes away from tuning off?
Right. Just, you know, some of this will take time, but we need to have that sense of urgency. The biggest challenge we all face is the climate emergency. So why aren't all pension funds in the world aligned with net zero emissions and alignment with the Paris Agreement? I think they've all got to do that tomorrow. Otherwise, we're going to have serious problems. Thanks.
Debbie.
I think for me, it's an area where really perfection can get in the way of doing so much good. So my thinking is that we need to start somewhere, we need to start somehow, and we need to start now. So anyone who hasn't done that, I agree with Tony, now's the time.
Very good. Linda. Fighting spirits here. Yeah.
Well, I would say that the objectives have to be relevant to where you are, to the kind of membership that a pension fund has, for example, and where it's located, you know, socioeconomically and geographically even. So I don't think across the world we're going to have the same priorities, because we are starting off on very different bases, you know, where, yeah, I think you understand what I mean. The SDGs apply differently in Africa to Europe, to the US, to anywhere else in the world. So certainly some things that might not be a priority in other parts of the world are to us. And we might not be prioritizing certain standards that just seem obvious to you from where you sit. So I think we need a broader discussion about what impact means to everyone.
Yvonne, your final word.
Yeah, two things from my side. I would invite all pension funds, wherever they are in the world, to co-create solutions. So not focus on the barriers, but look how to overcome them and really engage in developing products that work for you. And if you are too small, team up with others.
Very good. So, well, I'm afraid we'll have to leave it at this. I apologize once again for not being able to join you in time. We could have gone on for another hour for sure. Thank you so much for all your wise words, and yeah, thanks to the audience, and hopefully we'll have a fruitful another day of conferencing ahead of us. Thank you all.